If you are in your 20s, you have a great opportunity to start investing and building your wealth. Investing is not only for the rich or the old, it is for anyone who wants to achieve their financial goals and secure their future. In this video, I will show you the 5 benefits of investing in your 20s and some general principles, along with some examples that can help you choose a suitable investment. These are 5 reasons why you should invest in your 20s. 1. Time. One of the benefits of investing in your 20s is that you have more time to grow your wealth and take advantage of compound interest, which is the interest you earn on your initial investment plus the interest you earn on the interest. This means that your money grows faster over time as long as you reinvest your earnings. 2. Risk. Another benefit of investing in your 20s is that you can take on more risk with your investments, which can lead to higher returns in the long run. You also have more time to recover from any losses or mistakes, as you have a longer investment horizon and a lower opportunity cost. 3. Experiences. A third benefit of investing in your 20s is that you can learn from your experiences and improve your investing skills. You can also use your tech-savvy skills to access online tools and platforms that can help you with your investing decisions, such as robo-advisors, financial apps, or online courses. 4. Financial habits. A fourth benefit of investing in your 20s is that you can develop healthy financial habits, such as saving, budgeting, and making informed decisions about your money. This means that you are able to manage your money effectively and efficiently. Investing can help you cultivate a mindset of financial discipline and responsibility by requiring you to set clear and realistic goals, take calculated risks, and monitor and adjust your strategy according to your performance and market conditions. 5. Passive income. A fifth benefit of investing in your 20s is that you can generate passive income from your investments, such as dividends, interest, or rent. Passive income is income that you earn without active involvement or work. However, investing can be risky and uncertain. Your passive income may stop or decrease if your investments lose value or stop paying you. So, you should research well, invest in different things, and get professional advice before investing. For example, if you invest $10,000 at 12% interest per year, compounded monthly, you will earn interest on your money every month. This means that your money will grow faster than if you only earned interest once a year. This is called compound interest. After 10 years, your $10,000 will become $33,066.76. This is more than 3 times your original money. But if you wait until you are 30 years old to start investing, you will miss out on 10 years of compound interest. You will still have $33,066.76 after 10 years, but you could have had much more. If you compare how much money you would have if you invested from 20 to 40 years old, versus from 30 to 40 years old, you will see a big difference. If you invested from 20 to 40 years old, you would have $108,948.72. If you invested from 30 to 40 years old, you would have $33,066.76. The difference is $75,881.96. This means that by investing 10 years earlier, you would have almost $76,000 more by the time you are 40 years old. This is why it is better to start investing in your 20s. You have more time to grow your money and learn from your mistakes. There is no definitive answer to what kind of investment is good for beginners, as different investors may have different goals, risk preferences, and budgets. However, these are some general principles that can help you choose a suitable investment. 1. Diversifying your portfolio. This means investing in a variety of assets that have different characteristics, such as risk, return, liquidity, and correlation. This way, you can lower the risk of losing money and increase the chance of making money from your investments. For example, stocks are riskier but can earn more than bonds. Bonds are steadier but pay less than stocks. Cash is the safest but has the lowest return. Commodities can protect against price changes but are also very risky and costly. 2. Invest in low-cost index funds or exchange-traded funds. These are types of investment funds that aim to replicate the returns of a specific index or benchmark. An index is a collection of securities that represent a certain market or sector, such as the S&P 500 or the Nasdaq 100. A benchmark is a standard that is used to measure the performance of an investment or a portfolio. Low-cost index funds and exchange-traded funds are investment funds that offer exposure to a large and diversified group of securities, while reducing costs, risks, and taxes. They differ in how they are traded. Index funds are mutual funds that trade at the end of the day at the fund's net asset value, while exchange-traded funds are securities that trade throughout the day at the market price. Index funds are simpler and more convenient for regular and consistent investing, while exchange-traded funds are more flexible and efficient for frequent and opportunistic trading. 3. Tax-advantaged accounts. These are financial accounts that offer tax benefits to investors who save and invest for specific purposes, such as retirement or medical expenses. These benefits can include tax deductions, deferrals, or exemptions, depending on the type of account. Some common examples of tax-advantaged accounts are individual retirement accounts, IRAs. These are accounts that let you save for retirement with pre-tax or after-tax contributions, depending on whether you choose a traditional or a Roth IRA. 401ks. These are retirement plans from your employer that help you save money with less taxes. Your employer may also add some money to your plan. You don't pay taxes on your money until you retire, when you take it out. Health savings accounts, HSA. These are accounts that help you pay for medical expenses with tax-free money. HSAs have rules about how much you can put in and when you can take money out. 4. Start early and invest regularly. This will help you benefit from the power of compounding, which means earning interest on your interest, and build a habit of saving and investing for the long term. Some examples of good investments for beginners are high-yield savings accounts. These are bank accounts that offer higher interest rates than traditional savings accounts, while still allowing you to access your money anytime. They are great for saving for short-term goals or building an emergency fund. Certificates of deposit. These are fixed-term deposits that pay a guaranteed interest rate, usually higher than high-yield savings accounts. They are ideal for saving for medium-term goals or locking in a rate when interest rates are low. However, they have penalties for early withdrawal, so you need to be sure you won't need the money before the maturity date. Roth IRAs. This is a type of individual retirement account that lets you save money for retirement with after-tax dollars. This means you pay taxes on your income before you put it in the account, but you don't pay taxes when you take it out in retirement. This account is ideal for young investors who expect to be in a higher tax bracket in the future. These are just some of the many investment options available for beginners, and you should do your own research and consult a financial advisor before making any investment decisions. Investing can be rewarding and fun, but it also involves risks and uncertainties. The key is to start small, learn from your mistakes, and enjoy the journey. Thank you for watching. I hope you learned something new and useful. Please leave a comment below and let me know what you think about it. I'll see you in the next video.